A U.S. default would have serious repercussions for the global economy, as the IMF warned recently. A default means that the U.S. government would fail to pay its debts and obligations, such as interest on Treasury bonds, Social Security benefits, military salaries, and tax refunds. This would undermine the trust and confidence that investors and creditors have in the U.S. as the world's largest economy and reserve currency issuer. A U.S. default would trigger a spike in interest rates, as lenders would demand higher compensation for the increased risk of lending to the U.S. or holding its debt. Higher interest rates would make borrowing more expensive for consumers, businesses, and governments, reducing spending and investment. This would slow down economic growth and lead to lower tax revenues, worsening the fiscal situation. A U.S. default would also cause a collapse in stock markets, as investors would panic and sell their assets in search of safety and liquidity. A stock market crash would wipe out trillions of dollars of wealth for households, pension funds, and corporations, reducing their consumption and investment. This would also hurt economic growth and employment. A U.S. default would have spillover effects on the rest of the world, as many countries and institutions are exposed to U.S. debt and assets. A default would cause a global financial crisis, as banks and financial markets would face liquidity shortages and solvency risks. A default would also disrupt global trade and payments, as many transactions are denominated in U.S. dollars or rely on U.S. financial institutions. A default would also damage the credibility and influence of the U.S. in international affairs, as it would signal a lack of political will and responsibility to honor its commitments. In short, a U.S. default would be an economic disaster that could plunge the world into a deep recession, with devastating consequences for millions of people. That is why it is imperative that Congress raises the debt ceiling before it is too late. The debt ceiling is a legal limit on how much the U.S. government can borrow to pay its bills. It was set at $31.4 trillion in January 2023, and the Treasury Department has been using accounting tricks to avoid breaching it ever since. But those tricks will run out soon, and Treasury Secretary Janet Yellen has warned that the U.S. could default on its debt as early as June 1 if Congress does not act to raise or suspend the limit. A default would be disastrous for the U.S. and the global economy. It would mean that the government could not pay its obligations, such as interest on its debt, Social Security benefits, military salaries, and tax refunds. It would also trigger a sharp rise in interest rates, a plunge in stock prices, a loss of confidence in the U.S. dollar, and a recession that could wipe out millions of jobs. But raising or suspending the debt ceiling is not a simple matter. It requires the approval of both chambers of Congress and the President. And right now, there is no sign of a bipartisan agreement on how to do it. The Democrats, who control the White House and both houses of Congress, want to raise or suspend the debt ceiling without any conditions. They argue that the debt ceiling is not about new spending, but about paying for what Congress has already approved. They also point out that they cooperated with former President Trump and the Republicans to raise or suspend the debt ceiling 3 times during his administration. The Republicans, however, are opposed to raising or suspending the debt ceiling without spending cuts or other concessions from the Democrats. They say that the debt ceiling is an opportunity to rein in the government spending and borrowing, which they claim are out of control and threaten the country's fiscal health. They also accuse the Democrats of pursuing a radical agenda of massive spending and taxation that will hurt the economy and the American people. Adding to the impasse is the influence of former President Trump, who still commands loyalty from many Republicans. Trump has urged his party to demand spending cuts in exchange for raising the debt limit, and has threatened to endorse primary challengers against any Republican who votes for a clean increase or suspension. He has also repeated his baseless claims that he won the 2020 election and that President Biden is illegitimate. The political situation is tense and complex, and the clock is ticking. If Congress and the President do not reach a deal soon, they risk triggering a default crisis that could have severe consequences for everyone. The stakes are high, and so are the challenges.